Welcome to the deep dive. Today, we're tackling, well, a pretty huge topic. Navigating the financial world as an immigrant in three key countries: Canada, the UK, and the US.
It really is a challenge. I mean, you arrive, maybe you have a job lined up, but how do you plug into the financial system? We're talking basic banking first, and then the big one, buying a home, often without any local credit track record.
Right, and starting with that very first step, just getting a bank account, our sources suggest it's maybe surprisingly not too difficult in Canada. Seems like the big banks are quite welcoming.
That's what we found.
Yeah.
All the majors,
Yeah.
RBC, TD, Scotia, BMO, CIBC, they all have specific newcomer packages.
And what's really interesting, you pulled this out, is that sometimes these deals are actually better than what they offer people who've banked there for years.
Exactly. It sounds odd, right? But it's a long game for them.
How so? Is it just marketing, trying to grab customers early?
Well, yes and no. It's basically a customer acquisition strategy. They see newcomers as potentially very valuable clients down the road. Mortgages, investments, the whole package. So they might waive some fees up front, give a small credit card limit, things like that, to get you in the door.
So they're willing to lose a bit initially.
To capture your entire financial future, potentially. And since the actual package differences between the banks aren't usually massive, the sources say convenience often wins out. Which branch is closest.
Okay, so opening the account might be smoothish, but what about using it day to day? We did see some, let's say, friction points mentioned.
Oh, definitely. There are hurdles. Like one person mentioned starting with RBC in Canada and being hit with a $1,000 daily transfer limit initially.
Ouch. So if your first month's rent is, say, $3,000.
You're making 3 separate transfers? Yeah, exactly. Imagine juggling that when you're trying to find furniture and set up utilities. It's a real headache. And the standard advice everywhere is watch out for monthly fees, keep that minimum balance if you need to.
That initial ease in Canada, even with those kinks, seems different from the U.S. setup. Over there, the Social Security number, the SSN, feels like the absolute key to everything financial. What happens if you arrive and you just don't have one yet?
The classic U.S. catch-22. It's true, no SSN can block you from even basic things like a checking account sometimes. That's where the ITIN becomes so crucial.
An ITN, right. That's the Individual Taxpayer Identification Number.
Exactly. It's a 9-digit number the IRS gives out for tax purposes. So if you're not eligible for an SSN, maybe you're non-resident earning income, or a dependent spouse, you get an ITN. And having it lets you file U.S. tax returns, which, as we'll get into, is absolutely vital for things like mortgages later on.
So the U.S. system seems very focused on tax identity right from the get-go. Canada's more about just getting you banked first. What about the U.K.? Is it like the U.S. needing specific ID numbers, or more like Canada?
The U.K. is, well, it's sort of in the middle, maybe. The big high street banks, it's just what they call the main retail banks like Barclays, HSBC, NatWest. They can be more flexible than the U.S. on day one for a basic account. But the hurdle shifts immediately to proving where you live.
Proof of address. The classic.
Yeah, utility bills, rental agreements. But getting those documents recognized quickly can be frustrating, especially if you're used to everything being digital. It really underscores why that next step, building some kind of local financial track record, is so important, whichever country you're in.
And the advice there was refreshingly simple, wasn't it? Don't aim too high initially.
Exactly. Start small, build proof, get an affordable internet plan, a mobile phone contract, pay those bills on time every single month. Those small, consistent payments over, say, 12 months. That's the foundation of your new credit history. You absolutely need that for the bigger goal: homeownership.
Okay, let's jump across the pond then. Let's unpack the path to buying a home in the UK, specifically for someone on a skilled worker visa, which used to be called Tier 2, right?
That's right. And the UK system, it's heavily weighted towards time and stability. The good news is approval rates for foreign nationals are going up. But the lenders are still pretty strict.
What do they look for, typically?
Generally, they want to see you've been living in the UK for at least 12, maybe even 24 months. They also want to see you have at least, say, 2 years left on your visa, and you probably need to be settled in your current UK job for maybe 3 to 6 months.
Okay, stability. And the deposit, the down payment that seems to change dramatically based on how long you've been there. This feels critical for anyone planning this.
Absolutely critical. The sources paint a really clear picture here. If you've been in the UK for less than a year, you're probably looking at needing a pretty hefty deposit. 10 to 25% of the property value.
Which means the bank is only lending you 75 to 90% the loan to value, or LTV.
Precisely. A 75% LTV means you need that 25% deposit. But here's the kicker. Cross that 2-year residency mark, and suddenly things can change.
How much change?
Significantly. The required deposit can drop way down, sometimes to 10%, maybe even 5%, or potentially lower in some niche situations, allowing for maybe 90, 95, even 100% LTV in rare cases. That 2-year point is a massive lever.
Wow. Okay. So patience really pays off there. We also saw a note that certain key workers might get slightly better terms.
Yeah, possibly. People working for the NHS, teachers, some specialist lenders might offer them slightly more favorable conditions. It's worth asking about.
And who are these lenders? Are we talking the big high street names again?
Well, the high street banks like Barclays and HSBC will consider applications from visa holders, but the consensus from the sources is that you often get more flexibility from specialist lenders or the smaller building societies.
Yeah.
They're just more used to complex cases.
Got it. And one quick win for boosting your UK credit profile.
Register to vote. Get on the electoral roll. It doesn't directly impact your finances, but it's a key piece of data the credit agencies use to verify who you are and where you live. Simple, but important.
Okay, good tip. Let's swing back to the US now. We mentioned the ITIN for tax purposes. Can you actually get a mortgage with just an ITIN if you don't have that SSN?
Yes, you absolutely can. There are specific ITIN mortgage programs out there designed for this situation, usually for buying your main home.
What are the requirements like for those?
You need a valid ITIN, obviously, and you have to be residing in the U.S. Credit score requirements can be relatively forgiving, sometimes down to around 660. But, and this is a big but, the down payment is usually higher.
Higher than standard loans?
Definitely. Minimums often start at 15%. And if you're in expensive states like California, Hawaii, or Illinois, expect that to jump to 20% minimum, so significantly more cash up front.
15 to 20% is a serious chunk of change. But you mentioned another huge hurdle in the U.S. system using income you earned outside the U.S. That sounds like a paperwork nightmare.
It really is often the biggest bottleneck, and it affects pretty much all the main loan types. Conventional, FHA, VA, the lot. The rules are quite strict.
Like what? What do they demand?
Universally, you need to prove you're legally allowed to live and work in the U.S. You generally need some U.S. credit history. Often they want to see like 3 active accounts that have been open for at least 12 months. And crucially, you must have filed U.S. tax returns for the past 2 years.
There's the ITIN link again. It enables those tax returns.
Exactly. It's the foundation. And then there's the documentation itself. Anything not in English needs a certified translation. That adds time, adds cost.
And what about the money itself? The down payment funds from overseas?
That money has to land in a U.S. bank account converted to U.S. dollars. And then the lender needs to see it sitting there, seasoned for usually 60 days. They need bank statements showing where it came from. That source of funds verification is non-negotiable. They're really digging into the money's history.
Okay, so the U.S. demands tax compliance and a clear money trail. Let's go back to Canada one last time for the mortgage piece. We said banking was easier. How does the government, through the CMHC, that's the Canada Mortgage and Housing Corporation, help newcomers overcome that lack of local credit history problem?
This is really where Canada shines, I think. CMHC offers significant flexibility. They explicitly recognize that newcomers won't have a long Canadian credit file, so they allow for alternative ways to prove you're creditworthy.
Alternative methods. What does that actually mean in practice? It sounds less rigid than just a credit score.
It is. They might accept things like an international credit report from your home country, or maybe a reference letter from your bank back home.
Okay, but what if you don't have those, or they aren't enough?
Then they look at your track record of paying other regular bills in Canada over the last 12 months. Think rent receipts showing on-time payments, utility bills, cable or internet bills, even proof of consistent insurance payments or regular savings deposits.
Wow, so they're actually using your real-world payment habits as a substitute for a formal credit score history. That feels sensible.
It's quite practical, yeah. It allows good financial behavior to count.
And who qualifies for this CMHC-insured financing? Is it just for permanent residents?
No, it's broader. Permanent residents get access to the full range of CMHC products. But non-permanent residents can also qualify as long as they're legally allowed to work in Canada.
And the basic requirements. Minimum down payment. Credit score.
The minimum down payment starts at just 5%, which is quite low. They do need at least one person on the mortgage application to have a minimum credit score, typically 600, though they have that flexibility we just talked about.
And what about the loan term, the amortization?
There's a potential benefit there too. For first-time buyers, or if you're buying a brand new home, you might qualify for up to a 30-year amortization period. even with a down payment under 20%. Normally, it's capped at 25 years for high-ratio mortgages.
Okay, so summarizing the approaches. Canada offers flexibility on proving creditworthiness. The UK uses time in the country to reduce deposit needs. And the US provides the ITIN path for those without an SSN, but demands higher deposits and rigorous fund tracking. What's the big picture takeaway from all this?
Well, beyond the obvious challenge of lacking local credit history, the interesting thing is how each country tries to mitigate the perceived risk. Canada looks for alternative evidence of reliability, paying your rent, your bills. The U.S. uses tax compliance via the ITIN as its primary gatekeeper. The U.K. bets on stability. If you've been there 2 years, you're seen as lower risk.
So they're all trying to answer the same question. Can we trust this person to pay back a huge loan? They just use different proxies for trust.
Exactly. And this is where having expert help becomes so vital, isn't it? The sources were really clear on the value of a specialist mortgage broker.
Right, because navigating this alone seems incredibly daunting.
It really does.
Yeah.
Think about the U.S. visa requirements we touched on, an H-1B versus an L-1A versus a TN visa. Each might have slightly different documentation needs for the mortgage lender. Your average bank employee might not know the difference, but a specialist broker who deals with immigrants will.
They know which lenders are more comfortable with certain visa types or with foreign income situations.
Precisely. And they're invaluable for managing that mountain of paperwork, especially proving the source of overseas funds. Getting that audit trail wrong can completely derail your application in any of these countries. That seems to be a universal pain point.
So let's recap the key differences one last time for everyone listening. Canada, unique flexibility on how you demonstrate creditworthiness. UK time is the magic ingredient for lowering that deposit. US, the ITIN opens doors, but expect higher down payments and intense scrutiny on where your money came from.
And the overall message seems to be, yes, systems exist to help newcomers buy homes, which is fantastic, but the onus is really on you, the buyer, to be incredibly organized with your documents, get translations early, track every penny you transfer, and definitely seek out advisors who specialize in newcomer mortgages.
Yeah.
Don't assume the standard rules or processes apply.
That point about tracking the money, the 60-day seasoning rule in the U.S., the need for an audit trail everywhere.
Yeah.
It does make you think, doesn't it? In a world where money zips around globally in seconds.
Right. Why is proving where your down payment came from historically still such a major time-consuming hurdle? It really highlights a core tension. Even with all the fintech and instant transfers, when it comes to mortgages, big money, big risk, the traditional financial system still defaults to demanding a slow, painstaking verification of the past. That backward-looking documentation requirement, I think, remains the single biggest bureaucratic obstacle for immigrants trying to buy a home, no matter which of these three countries they choose.